In this week's video, we'll review the latest charts and data in the context of a surprising labor report to help us answer the question, do the charts favor the bulls or the bears? This segment of the video is being recorded at 9:30 p.m. Eastern Time on Friday, thus we will be moving rapidly. Things did not look particularly great at the end of the year, with the Nasdaq Composite Index making a new bear market low on December 28th. Things started to improve on January 4th. As covered in detail on January 6th, the present-day charts still support the concept of improvement. Labor report was released on Friday, February 3rd at 8:30 a.m. Eastern Time, affectionately known as non-farm payrolls. The median forecast, 187,000. The actual number, nowhere near expectations, came in at 517,000. As you might imagine, there was a reaction to the report in the bond market, but yields, they moved up a little bit. They're still significantly below where they were a month ago. Two-year yield significantly, in a big way, below where it was 3 months ago. Now, that may change walking forward, but it didn't change significantly on Friday. As we've noted in recent videos and recently on Twitter, the data that we have in hand just does not look recessionary, just as this number does not look recessionary. So we have to keep in mind that all data that's related to the concept of this is what's happened historically during a recession, example, the table that we've covered numerous times in these videos, all of that somewhat needs to be taken with a grain of salt until we see some significant and meaningful deterioration in some of the important data sets. That may happen, hasn't happened yet. If we were to take this chart of the S&P 500 index all the way out to 2010, you'll notice that in the dot-com bust bear market and in the financial crisis bear market, the transition from bull to bear and back to bull, bull to bear and back to bull, looks very, very similar. That's why the market model can be useful. That's why technical analysis can be useful. Everything that we cover in these weekly videos speaks to the net aggregate opinion of all market participants related to all subjects on all time frames, and that's reflected in price. This is what it looks like when the net aggregate opinion rolls over. This is what it looks like when the net aggregate opinion turns up. When we review the charts this week, we should keep in mind technical analysis tracks the past. It does not predict the future. You have to use your own intelligence to draw conclusions about what the past activity of some traders may say about the future activity of other traders. Here's an example. This shift here, this turn in the moving averages, that's the past activity of some traders. What does it say about the future activity of other traders? What it says is the probability of other traders coming in behind the initial traders is higher because the trend is turning up. Same concepts applied here at the 2009 low. A good portion of this week's video is recorded on Thursday night, so a fair question would be, did this number significantly change the charts? There's a very, very easy way to answer that. Is the equal weight S&P 500 as of the close on Thursday, February 2nd. If we fast forward, how significantly does this chart change after the labor report? Before? After? You can see it really didn't do anything to the type of data that we're analyzing in this week's video, and for the most part, that's true across all charts covered in this week's video. No need to drop in new charts. It's a very, very good-looking setup here, and we have similar setups in numerous markets in the present day. The odds up here are significantly more favorable than they were out here. This shift speaks to the past activity of some traders. This look speaks to the probabilities about what other traders and investors may do behind those traders. This is an extremely key point in this environment about risk management. All of that is based on the knowns today and the base case about future outcomes. So if the information changes rapidly, the message from the charts can change rapidly. The knowns and expectations on January 1st, 2020 quite a bit different than the knowns and expectations on February 19th of 2020. Why is that important today? Well, it's always important, and this concept always applies. However, in this environment where inflation and interest rates and Fed policy are the biggest issues, an unexpected number, an unexpected move by the Fed, an unexpected and sharp move in interest rates can change all of this rapidly. And how would we know if that's the case? Price would move from up here rapidly down here. Fair question might be, doesn't that make the charts useless? To the contrary, if that were to happen, price were to move rapidly from here to here, and we're monitoring this chart, that's going to be wonderful information relative to risk management. So the moral of the story in this environment, pay close attention, especially when the Fed is involved, interest rates are involved, or inflation data. We should be able to ask and answer this question. What would I do if price plummeted to this side of the moving averages and closed below the December low? How would I handle that? The base case is that the probabilities have improved significantly and price will move in this direction. If the knowns or expectations about the future shift significantly, all of these charts that we're covering this week will shift. So there will be information in those shifts. Shifts in knowns and expectations can cause relatively slow changes in the trend or rapid changes. Common sense tells us that this move from point A to point B up here could have been heavily influenced by this hard data. This is the Global Inflation Surprise Index. So when it's falling, it's telling you that inflation reports are coming in better than expected. This is global, this is US, Eurozone, and emerging markets. Thus, this shift from point A to point B, point A to point B, speaks to a shift about very important knowns and expectations. And it's one of the major factors that the market has gone from a very concerning profile to an encouraging profile right now. If the facts change, then we have to be willing to reassess the probabilities. And it's possible in this environment that we might have to do so rapidly. That's one of the reasons why we use every tactical tool we have in our toolkit to try to assess the probability of a false breakout. No tool, signal, or approach in the markets is perfect, far from it. Example, if you looked at a chart in 2001 during the dot-com bust bear market, there's a setup that's very similar to this. Now, there are some significant differences. In 2001, you never get a confident break above the base as we do in the present day. In 2001, you never take out intraday levels here, nor do you exceed levels out here. These are all things that we've done in the present day that look different from 2001. Friday charts, we've been saying in these videos that we want to see a weekly close above this level. We want to make a weekly higher high above 4072. We can now check that box. We closed well above it at 4136. Price was below a downward sloping 30-week. Now we're above an upward sloping 30-week. And most of the leadership charts look quite a bit better, meaning price did all of this above the 30-week. S&P 500's a laggard. We have a ton of setups that look very, very similar to this. This price pattern in here, price relative to the 30-week, this is one of the weaker price patterns relative to leadership. Still constructive, but we can find better ones. We've covered this chart many times. We cover it later in the video. Weekly RSI, I'd like to see it above this level and this level. Same applies to this chart. Covered it in the past. We'll cover it again later in this video. One of our differentiators between these bear markets and the present day is we want to see TSI close above zero on a weekly basis. So a lot of good things happened this week. We closed above 4072. RSI weekly closed above 55. Weekly TSI, or the True Strength Index, closed above zero. It looks different from the prior two significant bear markets. And the S&P 500 is late in doing this relative to market leaders, but it's making a higher high and closing above an upward sloping 30-week moving average. weekly MACD, weekly RSI, weekly TSI, close, close, close. If something changes rapidly and significantly, there are ways to track that. This is a relatively slow change. It's taken several weeks. So in the present day, if this line and this ratio shot back up here rapidly, that would be concerning. Kind of rare to see something like that, especially with momentum like this, but we have to be open to a wide range of outcomes. Once again, did this, or the fact that interest rates were higher on Friday, significantly change the profile of the market? This is the chart dated December 30th. Covered it. This is what you'd be looking for. Bullish. This would be bullish. This. This is what it looked like at the end of last year. This is what the exact same chart looks like after NFP on Friday. This is the close on Friday, February 3rd. Compare this to this and this. S&P 500, S&P 500, S&P 500, S&P 500. Green, S&P 500. Green on the 30th, down in this area on February 3rd. Very favorable setup in its present form. January 6th said we wanted to see something like this. How does this chart look after NFP? No significant change relative to the read. Still favorable for risk on. A lot of good things happening on the monthly chart of the German DAX. Long-term momentum, Koppik curve, RSI back above 50, price above an upward sloping 50-month moving average and above this period of consolidation. Left, head, right. Things have been improving. February 2nd, very favorable setup. We have a lot of these. Market leaders look very good. Dean over at Sentiment Trader, just like us, he takes a weight of the evidence approach. You can pause your video player here and read these bullet points in the summary here. Like many of the signals that we cover, something that just happened in 2023 is typically bullish, and it typically does not align with a bear market. 12 months later, average gain 17.7%, 83% of the cases positive. The average max loss 2.7%. Average max gain almost 20%. Simply speaks to probabilities. To assess odds, we want to do two things. Does the present day look like bullish scenarios? Does it look like a major low? And number two, do we have things that are happening in the present day that don't look like a bear market? Example, full stochastic. We've covered this in the past. When you move from down here, which is rare, to above the center line, down here to above the center line. This occurs right here after the major low in 2003. It doesn't happen in the bear market. This occurs after the major low in 2009. It does not occur within the context of a bear market. It just happened at the end of January. Monthly Koppik turning up, monthly Koppik turning up, monthly Koppik turning up. Speaks to odds. Prices above blue and red. Prices below blue and red. This is the past activity of some traders. Enough momentum to get a close above the center line. What does it say about the potential future activity of other traders? Everything that we just said about momentum here applies to this chart of EFA, very similar to VEA. We get a monthly close above the center line at the end of January. Monthly cloud, this is a much improved look relative to being down here. We've covered this in the past from a bearish perspective. When we were down here, we said we just don't have these things yet. We want this, this, and this. This, this, and this. This is the major low. After the major low in 2009, these three things happen. In the present day, we did not have them recently. Now we have all of them. Green above price, we have it. Price above the cloud. As of Thursday, we have it. Blue above red, we have it. So once again, doesn't look like a bear market anymore. Doesn't look like a major correction anymore. It looks more like after the low. In its present form, this is a constructive look. Semiconductors divided by the equal weight S&P 500. If we move down here again, that assessment would change. How about our bottoming attempt scoring system? We've been updating it really every day, sometimes more than once a day. It's been very, very useful. This is a little blurb about the model. This was the reading on August 26th of last year. We could check roughly 45% of the bullish boxes. Where do we stand in the present day? Does it align with a look like this? August 26th, February 3rd, 2023, came in at an even 86%. Doesn't predict anything, it speaks to odds. Just as this look here, this favorable setup on February 3rd is based on knowns and current expectations. The same exact thing can be said for this number here. If something shifts significantly, and this changes or this changes, then absolutely positively yes, this can change as well. What is this telling us? It says typically when you see a number like this, relative to history, the low is in. It's in the rearview mirror. Doesn't mean the low is in the present day. Hillary Clinton had a very high probability of winning the election. She did not win. That's not a failure of probabilities. If it's not 100%, it's not 100%. Just a tactical issue going forward. We update these charts. We use the same charts. We've been using some of them for months, and that's a good thing because we get to see how they change. Some of these charts that were updated still say 2022. The charts that we're covering go into 2023. Dow Advanced Decline Line. Rejected. Significantly different look in 2023. Here's a warning for the entire video. Most of these charts are dated Thursday, February 2nd. So we're looking at weekly charts on a Thursday. Just keep that in mind. They may look different on Friday. This chart already looks different relative to what's in the rearview mirror here in 2022. Also noteworthy, we've mentioned before, possibly on Twitter, possibly in these videos, a lot of the setups that we have are similar to November of 2020. This look here, possible we're getting a similar look in the present day. There are a lot of bullish signals that we could cover. You can go to Mark's Twitter feed to find more about this signal from Rob Anderson of Ned Davis Research. This is a positive divergence. This is price. This is the NASDAQ. It's way down here in 2023. Breadth bottomed in May and has been improving considerably. And this look here is quite a bit different than anything we saw at any point in 2022. We've covered these charts in the past and said they really don't look like a bottom yet. They're starting to look more like a bottoming process in here. NASDAQ's been doing some nice things. It's possible it's trying to regain a leadership role. It still has some work to do. Look at RSI down here, NASDAQ relative to the S&P 500. This too looks better than anything we saw during the entire year in 2022. Been a long time since this ratio was anywhere near the 200-day moving average, shown in red. If it makes a stand here, it will be making a stand at a logical level. We'll show a ton of charts this week. We have consolidation. Come down here, we hold. Tight cluster on your moving averages. This is a good look. They're turning up, and then price eventually exceeds these highs and breaks out. The longer that look holds, the more relevant it becomes. Also noteworthy, on all of these charts, they can help us if things fall apart. If price moves into this area down here, it could get ugly very, very quickly. And there would be information in those breakdowns. Right now, this chart looks good. Weekly chart, we'll have to see what it looks like at the end of the week. Right now, it's at 59-ish. Better than anything we saw in 2022, but still has a little bit of work to do. This is a nice look here intra-week. We'll show a ton of charts this week where you can see some form of a left shoulder, a head, and a right shoulder. That's an inverse head and shoulders pattern. It's potentially bullish, especially when you break and hold above the neckline. Potential resistance all in here. February 2nd, the German DAX was above those levels. If you know your market history, this bear market, the dot-com bust bear market, really took off to the downside in September of 2000. So compare the look of price in the moving averages in this bearish episode here and in this bearish episode here to the present day. And then compare it to this period and this period. You can see price held above blue here. It looks like it's trying to make a higher high. We really don't get anything like that in here. Don't really get a bounce at the moving average. Right now, blue, the fastest moving average, is on top. Price is above both of the moving averages, and the slopes of them are both up or flattish and turning up. Earlier this week on Twitter, we said this was an inflection point look coming into this week. This is the look on February 2nd. Price trying to make a stand down here in October at a logical area, an upward sloping 200-week moving average in red. This was corporate bonds earlier this week. We still have a constructive look in the credit markets. Talked about this chart in detail last week. You can also make an argument that this is a breakout here from a 15-year consolidation box. And what just happened now was basically a retest of that bullish breakout. And thus far, the retest held at an upward sloping 200-week moving average. We held here and we held here. Is it possible this morphs into this? Absolutely, positively, yes. There's no question this looks quite a bit better in the present day. You can find this chart on our Twitter feed at ShivacoCapital.com. RSI here. We have a look now that we never had in this area here. This is 2000. The entire calendar year 2001, we never hit this level. Weekly RSI. Never hit it in calendar year 2002, and this is what's happening with price. And didn't hit it until the bottom was in 2003 in global stocks. Similar situation here. All of calendar year 2008 never hit this blue line. We hit this blue line last week on a closing basis. This looks different from this, and this looks different from this. Doesn't predict anything, just speaks to probabilities. This is also a nice look here. Compare this look here, left, head, right, to this look in here, and even this look in here. So weekly, you can see here, it's possible we're trying to nail down this type of look November of 2020. NASDAQ 100 trying to break the downward sloping trend line relative to the S&P 500. This is a daily chart. NDX divided by the S&P 500 has not been above the red 200-day moving average in quite some time. So this looks different than anything we've seen. RSI here, this is a nice look. RSI getting back above 70 is a sign of strength. Nice look in here with momentum. Momentum's down here in October. Got white space in here trying to break the downward sloping trend line. This is the NASDAQ 100 weekly. 200-week here in blue. This is the index in isolation. This is relative to the S&P 500. This is January of 2022. This chart looks different and better than anything that we've seen. Look how long the daily cloud has been green. You may remember we covered the concept of clouds in great detail in one of these weekly videos. This is the cheat sheet for the bearish look. This is the cheat sheet for the bullish look. So this is what a bear market looks like. This is what a turn looks like. So let's see where QQQ is as of February 2nd. And I might add, QQQ is not one of the leaders off of this low. It is a laggard. Green above price, not yet. Price above red, yes, we can check that box. Blue above red, can't check it yet. Price above the cloud, nope, we're below the cloud. Has the cloud turned from red to green? It's not particularly close at this point, so some work to do here. Also noteworthy, QQQ on a relative basis, opportunity cost, quite a bit weaker than another alternative, SP high beta down here. This is the same weekly cloud, it's just a relative cloud. Covered this chart many times in the past. We have a very attractive breakout and setup after a long period of consolidation. This is what risk on looks like in November of 2020. This is early 2022. This is what risk off looks like. Full bore bearish. If we're not there yet, we're close to full bore bullish. Good things happening from a leadership perspective on the monthly chart above an upward sloping 50-month. Both of these charts are SP high beta divided by the S&P 500. We talk about SP high beta a lot in these videos. What is SP high beta? But SP high beta invests in some of America's largest companies, basically blue chips. It's really just a weighting issue. This is on Twitter here. SP high beta has roughly 77% of its weight to tech, consumer discretionary, and financials. So this is a way to get exposure to technology and also see if tech can return to a leadership role. Right now, QQQ relative to SP high beta has a lot of work to do. So this is what the weekly cloud looks like on a laggard. This is what the weekly cloud looks like on February 2nd. This is a leadership cloud. Green above price, yes. Price above red, yes. Blue above red, yes. Price above the cloud, yes. Cloud red to green, yes. Doesn't predict anything, just speaks to probabilities. Similar situation, the mid-cap cloud looks quite a bit better than the laggards in tech and growth. Can check them all. All of these charts are as of February 2nd. This is a nice breakout here from a cluster. We have a battle between the bulls and the bears here. We break out, have a retest look here. This little pullback here, we stayed above an upward sloping 8-day moving average. Home builders weekly can check them all. Unlike the S&P 500 or SPY, the equal weight S&P 500, so the same stocks, just a different weighting, can check all of them. Wasn't long ago that it couldn't check any of them. On a relative basis, RSP continues to outperform SPY. SPY divided by RSP on February 2nd cannot check one of these bullish boxes. That may change, hasn't changed yet. Vanguard Europe can check them all. It's possible we have a shift from a US-centric world in investing. We're shifting a little bit back to non-US stocks. That's possible. This is the weekly cloud. Green below price, yes. Price below the cloud, yes. Cloud green to red, yes. Price below red, yes. And blue below red. So we can check them all, but we're near the cloud and still somewhat of an indecisive look here, but a vulnerable look. Looks quite a bit different than anything that we've seen on this chart going back to 2019. Breadth has been improving even when price was falling. Very, very similar situation. The VIX has been below 20. The longer it stays there, the more relevant it becomes. Is it possible the VIX is about to spike? Sure, it's possible. NYSE advanced decline line. This is when all of this started back here. This is the present day look. Why are 90% up days relevant? Well, they typically indicate institutional buying. And you're getting institutional buying here, 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 to be determined here, but we've seen a lot of 90% up days. Said for a long time this needed to try to turn. This is another chart that looks better than anything in here in 2022. It doesn't mean we've bottomed, it just increases the probability that we've bottomed. This is 2021 back here, trying to break out small cap 600 index relative to the S&P 500 index. This is your risk on look in November of 2020. Price above the moving averages and the slopes are up. This is a little bit more of a sleepy look, but trying to move. Remember we said breaking out above this line was a higher probability because momentum looked better. We were earlier in the momentum turn relative to up here where we're late. We've expended a lot of momentum to get up here and we fail. Look at the move here in momentum. We fail. We're still relatively early here. And the longer the breakout holds, the more relevant it becomes. We can treat moving averages just like price. This also looks different than anything that we've seen. We can even see somewhat of a messy inverse head and shoulders look in here, far from perfect. You can go to this Twitter feed and read more about this, but basically what this is saying is something just happened that typically does not happen in the midst of a bear market. In recent weeks, we were having trouble clearing 41.01, the close on February 2nd, 41.79. If you pause your video player and compare this look in here, look at price and the moving averages. This is a battle in here. The battle is lost when the moving averages are tight and price moves below. You either have or you're very close to a full bore bearish look here. We really got the mirror image down here. We've been battling in here, consolidating. Notice how the moving averages have gotten tighter and tighter and tighter as we move from left to right in here. Very similar up here. They get tighter and tighter and tighter as we move from left to right. This up here looks quite a bit different than this. This has got some work to do for a full bore bullish look, but this is the 250-day moving average, the 225 and the 200. But this is a nice look. Came down here. This was a battle in here. The bulls won that battle just as they won this battle down here. Came down, broke out, and exceeded this high here. Came back and even tagged an upward sloping 8-day and held. You can see the 225-day in black is trying to curl up potentially. Just as we're learning something about probabilities here, we would learn a lot about probabilities if this December low is exceeded and price stays below it. So for us, we have defensive game plans and ways to track positions that we own. Can't assume that everything is going to go well. We should do just the opposite. We should assume that it's not going to go well. If it goes well, then that's fine. If you look at this chart with an open mind in its present form, this is a fantastic look. Volume by price here. Huge battle in here. The moving averages are clustering. Again, we get that breakout look. It could fail, but right now it looks good. Also held down here at that logical level between the 38.2 and the 50% retracement of this A to B move. Covered this many times, this 30-week moving average. This is a slide from the January 6th video. Still had some work to do. If we fast forward to February 2nd, the close on February 2nd, this is starting to look a lot better in here. Like to see a weekly close above this level. We want to make sure we're interpreting things properly. Here's a failed attempt here in 2002. Realistic expectations about a wide range of outcomes. Having said that, this is some nice improvement. Typically, emerging market bonds would get a bid if inflation calmed down and rates were peaking or getting close to peaking. Left shoulder, head, shallower right shoulder, lots of buying interest in here. Price above an upward sloping, trying to turn up 30-week moving average. We get the breakout, a little bit of a retest look, and then we're trying to print a higher high. Not sure if we're going to hold this February 2nd. We are above this level we've talked about. Above this level that we've talked about. RSI is 58.9. If it carries into the end of the week, we'll learn something. Also look at this look up here relative to the Bollinger Bands. A lot of white space in the rearview mirror here. This is starting to look different. We've covered this chart many times, so we'll move quickly. 2002, fail near the center line on the True Strength Index momentum. Can't even get back to the center line in 2008. We hit it and eventually clear it in 2016. It's a bottom. And here, as of February 2nd, True Strength Index is slightly above zero. If you compare momentum in here objectively, make an argument, the fact that we're up here twice looks a little bit different than calendar year 2008. The longer price stays above, the more relevant it becomes. February 2nd, this looks different than anything that we've seen in the rear view mirror. Price trying to make a stand on an upward sloping 200-week moving average, logical. We did it here on Christmas Eve 2018. Momentum down here. Price from this point here, for the most part, going sideways. RSI trending upward. Look at the white space down here relative to this. Look at the white space down here relative to this. Similar concept down here. The momentum profile has slowly been improving, especially in here. Price is going sideways. Compare the looks in here. It's possible this week we will get the 1, 2, 3, fourth consecutive weekly close above the 40-week moving average in blue. Looks different than anything we've seen in here. This rally attempt fails here March, April of last year. Look at momentum here. Compare that to momentum here in the present day. There's a lot of white space down here trying to capture the center line on MACD. Is there any way we can objectively answer the question, how extended is the current rally? The answer is yes. This is daily ADX up here, black below both red and green. This is a sleepy, trendless market on January 31st. This is the daily time frame. The weekly time frame, black below both green and red. This is a sleepy trend. This is what an overextended downtrend looks like here. This is what an overextended uptrend looks like here. This is what an overextended downtrend looks like here. Notice where the market starts to rally. When black comes back in here, you really turn the corner. It's not magical, but it objectively says the trend could be just starting, which is logical. We've been consolidating for several months in here. That doesn't look like an extended market. Could it be extended in the short run? Sure, it could be. And even if good things happen, the market doesn't go up every day, week, month, or quarter even in a bull market. Have to have realistic expectations. Back to ADX. Notice when the rally starts in 2016 here. This is a really sleepy trend. Black way below red and green. Equal weight S&P 500 thus far has been stronger than the standard weight, exceeding the August high here. The S&P has not done that yet. February 2nd, if we get a weekly close above this level, that would be good. This is a nice improving momentum profile with MACD, weekly MACD clearly above zero. What does that mean? It means from a momentum perspective, you've flipped from a downtrend to an uptrend. For clients, what happens if we get a failed breakout and price does come down here and then plummets? We've got numerous charts for every position that we own that give us reference points. This is one example. This is anchored volume weighted average price. This is your battleground area in here. Just think of it as an area of possible support, and also on the way up, an area of possible resistance. So the longer you stay above it, the easier it is in theory to move up. Conversely, if we drop below these lines, the easier it will be to move down. This is a daily version. We also have 39-minute versions for every position we own. How is it helpful? If the market pulls back, you can basically say in here, it's not alarming at this point. If you get in here, you've got to start getting ready. If you get down here, very, very possible that you're going to have to manage risk. The jury's still out on interest rates. They look a lot more vulnerable. We can check a lot of these bearish boxes on the daily cloud, not the weekly cloud. But there's no question the 10-year yield looks more vulnerable than it did back here. Just keep this in mind. It's very important up here. Maximum flexibility 100% of the time. This is where the S&P 500 peaked in August of last year. This is the look. You stayed in the upward sloping channel. This looks different in the present day. Moving averages back here, even here when we pull back, they're looking a lot more vulnerable here. Doesn't mean we've rolled over. This is the trend in the US dollar down here. It's a weekly chart. This covers all major indexes in the United States. We're in the box. We were not in the box in December of 2022. This looks a little bit more like this and or this down here and down here. Doesn't guarantee anything, but it's just very difficult to say a major low is in place if you can't get into the green box. Clustering look here. Here's that bullish risk on breakout here. November of 2020 coming up again. Been consolidating here. February 2nd. This looks like an attempt at a bullish breakout with very, very tight moving averages here. We'll learn a lot here. If this moves in this direction, that's great. If we fail and come down here, that would be concerning. World Technology Index looks different than anything in here. 200 week. Covered this chart last week. The big chart stated January 26th. This is an updated one as of the close on February 2nd. Printing a new high above this 2022 high here. Telling us to keep an open mind about the S&P 500 eventually printing a new high. Speaks to odds. December 30th chart that we covered in a weekly video, not particularly encouraging here, high yield bonds. Then we said on January 6th, hey, it's looking a little bit better. This is the daily chart. This high, on a closing basis, exceeding this high, left, head, right. And this ugly looking chart on December 30th at year end, below the 200-week moving average, and the 200-week looks like it's flattening out. Much improved on February 2nd. Left, head, right. A lot of encouraging looks in the bond market. The small chart is SPSB, short-term corporate bonds. Covered this. This is LQD divided by IEF, up 0.62% for the week, February 2nd. There's some good things happening down here as well. A little bit more information here on our Twitter feed about this chart. If this breakout holds, and it's a mighty big if at this point, these types of charts will turn out to be extremely helpful. That's your risk on look here. Once again, November 2020, consolidation, look at the moving averages. This is IWM SPY. It has not exceeded this high here, but it's at least above the moving averages. This is your risk off look. A little bit different flavor. Small caps, SCHA divided by SPY looks quite a bit better. Exceeded this high on a closing basis. You can make an argument that this looks a little bit like this. The longer it holds, the more relevant it becomes. A lot of tight clusters on the moving averages with price turning up and the moving averages turning up. That's a good look. This is SCHA in isolation. 50-day at the COVID peak turns down. 50-day turns down here in Q4 of 2021. 50-day has been moving sideways and turning back up down here. This is January of 2022. Blue, the fastest moving average, is on the bottom. Slopes of all the moving averages are down and price is below. This looks a lot different in the present day. Doesn't predict anything. It speaks to odds. Very similar concepts here. This is an improved look, SCHM mid-cap relative to VTV value. We've covered this previously. So this is a defensive ETF, SP low volatility, divided by the equal weight S&P 500. So think risk off divided by risk on. So after the COVID low in 2020, the defensive ratio, weekly MACD, crosses the center line, 2020. Good things happened in the stock market. Momentum got very weak down here for the ratio, crossed the 200-week moving average. Here, we didn't even make it back to the 200-week. It's sloping down. MACD below zero. So this, similar to this, May and June of 2020, similar to this. Momentum for this ratio is stronger to the downside than anything that we saw during 2022. As noted, this is a weekly chart. Same concepts here on a daily chart with the 200-day moving average. Slope rolls over here as the stock market is bottoming in 2020. Slope turns up here as the stock market is peaking in late 2021. Here's the same slope in the present day. Versus the equal weight, same concepts daily. Now we're looking versus the standard weight. This is that defensive looking bearish breakout here. As recent as December 15th. That's it right in here. It turned out to be a failed breakout. And look how it failed. Here's the consolidation box. We break out, and then basically pull a Fed and do a 180, and now we've undercut this box. From an odds perspective, there's a lot of information in this look. This is a daily chart too. This is in the books. Slope is flattening out. Slope is turning up back here. Momentum looks quite a bit different than anything that we've seen all the way back to January of 2022. If short-term corporate bonds are outperforming the S&P 500, risk appetite is not particularly attractive for stock market bulls. Here's the trend line, April of 2022. Notice price in the moving averages. Same trend line we hold here right where the stock market peaks. This matches this peak in the stock market. This bounce here matches this peak in the stock market. This looks different from this, and this. Price above the moving averages here, they're trying to turn up. Price below the moving averages here, and blue, fastest moving average, has moved from the top to the bottom. Slopes turning down. You can find this tweet on our Twitter feed. It describes this chart here. The last time this happened, 2009, right here. We're still in a very unique environment with a lot of moving parts. Thus, we all know the only way any of this works is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.